Wednesday, February 14th, 2024, Maneco 64, home of alternative economics and contrarian views. You all probably remember 2008. Some of you don't, but that was the big subprime mortgage crisis that evolved into a great financial crisis. We started seeing the cracks in that back in the spring, I think, of 2007. And then it culminated, in September, October 2008. So it wasn't right away. And I think the commercial real estate uh, sector, or what is also commonly known as CRE, could be a major trigger for another huge crisis. And some people seem to think that CRE could make the subprime crisis that led to the great financial crisis be like a picnic in a park. Um, compared to the current crisis. And we're going to look at an article about that. And the reason why I think it could be is because there's so much more of that, but we'll come to that in a minute. Before I do, wanted to talk a little bit about the way the world is right now, especially in the West. There's a lot of talk, of course, of the fall of the West. We're seeing huge farmers revolts in Europe. We're seeing political division everywhere, especially in the US. We're seeing our leaders send tens of billions of our taxpayers, dollars and pounds, to dictators around the world so that the military industrial complex and the corporations and banks around them can continue to profit. So that's the example we're getting from our leaders. And is it any wonder that the rule of law is become like very something that it is not respected anymore in the West, and we're seeing that everywhere, not just in the US but here in the UK, with crime, theft, burglary. And if you can't trust your leaders or your bankers, I think you need to consider safeguarding your possessions, uh, your valuable possessions, real possessions, not digital, of course. And that's why about a year ago, maybe a bit less, I I joined up with the Dirty Man Safe. And yes, as you can see, the Dirty Man Safe, you bury your treasures, not your fears. And just read a little bit about the Dirty Man Safe here. Begin your security journey with exclusive perks. Unearth the unmatched protection of the Dirty Man Safe, a patent pending marvel design for your peace of mind. Durable, stealthy, and smart. It's your underground guardian. Sign up now and receive a special gift with your order plus a next extra 10% off via our affiliate links. Your safe haven is just an email away. So there you go. You can use my promo code Maneco10 and you get that 10% off. You receive, of course, a special gift as well. The link to the Dirty Man Safe is below in the description of the video. So let's get back to commercial real estate. And the reason I'm talking about it is that yesterday we had the CPI data, and on the surface, it didn't look that bad. But the financial markets are so leveraged. Uh, the liquidity is so fickle. Whenever there's a little problem in the financial markets, liquidity dries up. And that has been a problem since around 2015. And it was a huge problem in 2020, is one of the reasons why the Federal Reserve had to intervene with trillions in QE because liquidity just dried up. And what does that mean? Well, people, financial institutions, they wouldn't make markets for security. So people didn't know where prices were. They're selling things at levels that didn't make sense. And that's why the Fed had to intervene. And I have spoken about this for many years here on the channel, and it's all to do with derivatives. And derivatives are just side bets on underlying securities. And these bets are always very leveraged. And what does that mean? Well, people that bet, let's say, on $1 million of a security, they only have to put like five or $10,000 down. So when we see volatility in the markets like we saw yesterday, those derivatives become very dangerous, especially as liquidity dries up. So, as I said, on the surface, CPI, yeah, it dropped from 3.4 to 3.1, but the market expected a drop to 2.9. 0.2%. And you think, well, that was an overreaction. The stock market dropped like 700 points. The Dow, the 10-year yield rose like 20 basis points or 10 basis points. Yeah, bonds were sold off. Isn't it an overreaction? Yes, it feels like it, but I think it's because investors, traders, speculators, hedge funds, they're so desperate for liquidity. They're so desperate for the Fed to cut rates, to stop, this tightening that they're still doing through QT, that just a little bit of higher CPI makes them worried. And that's really um, ironic. And it just shows how the Fed has put itself in a corner. And it's not just Jay Powell, but it's been accumulating this situation since 1987, really, when Greenspan instituted the Greenspan put. So investors now are so conditioned to have the Fed save the day that whenever there's a little trouble like that, markets do this, and it doesn't bode well, in my opinion. We saw the 10-year yield actually come back to a level that was really important last year, 4.33%. And when we broke that last year, we went straight up to five. Yes, since the end of September, well, end of October last year, we came back down, went back below 4%, just at the tail end of last year and beginning of this year, and now we're retesting that 433. And what's that got to do with commercial real estate? Well, I was reading, and I spoke about this on the live stream some weeks ago, that there's about 1.7 trillion of commercial real estate loans due in the next 2 years. And a lot of the smaller regional banks have these kind of loans. The too big to fail are not as involved on a percentage basis as the small and regional banks. And that's why I think now we're seeing the regional banks, smaller banks like New York Community Bancorp get in trouble. And there's a really interesting article here from the dailydoom.com, and I'm going to put a link to it in the description. I'm not going to go through the whole article. I read it. So this is by David Haggith, and he says commercial real estate implodes across the news, talking banks scattered around the world with it. And that's really interesting because last year, when we saw a few banks collapse in March, that was due more to the securities holdings, the losses they were carrying in their treasury holdings. And now it's spreading to commercial real estate. And I think what happened last March is like the March, April 2007 of the subprime crisis. This is just evolving, and I think we could see a culmination of this crisis. So Mr. Haggith talks about the fact that this is not just happening in the States. A lot of banks around the world have an exposure to US commercial real estate. and also their own commercial real estate, I would add. So as you can see here, I'm gonna actually share this article with you. So here's the article: Commercial real estate implodes across the news. So as you can see here, even in China, they have some exposure. Shanghai Commercial Bank, CITIC Bank, Australia Macquarie Group, uh, and so on. And even in Europe now, as you can see here in Germany and Scandinavia, we are seeing commercial real estate exposure as a percentage of tangible equity in the 400, 500, 600, 700% range. So there you go, the leverage. The leverage is always there. People are addicted to leverage and debt. Golan said in an interview, if each of these banks takes a 15 cents write down for every dollar they lend to commercial real estate, which I'm not saying is a base case, but is completely reasonable scenario. Not only are these banks not investment grade, they're insolvent. So, and he says, will commercial real estate trigger the next financial crisis? There are dark clouds looming on the horizon. Another wave of regional bank troubles added to the burgeoning crisis in the commercial real estate market. The regional bank crisis was distinguished with liquidity, but reality showed that unrealized losses in the bank's balance sheets rose to all-time highs in the third quarter of 2023. And yeah, that balance sheet report of unrealized losses that should be coming out in about 10 to 12 days from the FDIC. So, and that will be for the fourth quarter of last year. Regional banks remain in deep trouble. According to Moody's, major U.S. banks are sitting on 650 billion in unrealized losses. Yeah, as I said, we're going to see get more details from that. Um, yeah, here's the important part, and it's not just for commercial real estate, it's also for the US Treasury, seeing that they have so much paper to sell this year, so much treasuries, like in the trillions in a time where a lot of foreign countries are paring back their holdings of treasuries. It's a problem, but let's go through this. Commercial property loans coming due in US jump to 929 billion. I spoke about 1.7 billion earlier, but that was for just that was for 2 years. This is for 2024. So nearly 20% of outstanding debt on US commercial and multifamily real estate, 929 billion, will mature this year, requiring refinancing of property sales. The volume of loans coming due swelled 40% from an earlier estimate of by the Mortgage Bankers Association of 659 billion, a surge attributed to loan extensions and other delays rather than new transactions. So, and this is his conclusion here. And I think it's worrying. Of course, it doesn't mean it's going to happen. It's possible, though. He says, with CRE prices down an average of 21% from their 2022 peak, it becomes hard to refinance loans that never paid down the principal. That's the other thing. They thought they could keep rolling it over cheaply, so they couldn't be bothered about the principal. They thought prices were going to keep going up. As is the case with most CRE bonds, where investors typically pay only interest only, right? Who wants to refi a loan of any kind when collateral is worth 20% less than the loan? Trouble is brewing for it this year. So yet another story claims uh, the commercial real estate collapse of 2024 will make the 2008 great financial collapse look like child's play. What do I think? anything's possible. And as I said in the beginning of this report, the debt is so much bigger today and interest rates are so much higher. Um, it's going to be a problem. So I wanted to show you uh, the 10-year Treasury yield because this is really important, not just for the Treasury refinancing. A lot of these rates that we're talking about here to refinance commercial real estate, uh, these rates are set off the what's called the risk-free rate of return, which is the what the government pays. The government is supposedly risk-free because it can just borrow and have the Fed print the money, right? So this is the level I was telling you about back last year. That was really important. We saw a spike to this it's around 433, 436 level, and then it came down, and then we broke through it. And as I said, once we broke this 433, we went straight up almost in a straight line to over 5%. Yes, we've seen a respite. Rates have come lower, but now they're starting to pick up. And notice how we're right here now after those numbers from the Bureau of Labor Statistics on CPI. So this is why it's so important here. Um, I would say if we break through this 433, we could go test 5% again, and that won't be a good thing. And I noticed as well the other day that Jamie Dimon said that the US government and the US in general has a debt problem and it's becoming unsustainable. So yeah, when Jamie Dimon's saying that, you need to listen because the bankers usually say everything's fine. I saw as well though that and it could be Jay Powell's equivalent to what Ben Bernanke said. I think back in 2007, he said the subprime mortgage crisis is contained. The economy is not going to go into a recession. Everything's fine. And that's the same thing Jay Powers said about the small regional banks and commercial real estate. He says it can be contained. Yeah, some banks might fail, but we'll be able to, you know, uh, make sure that's fixed. And I'm not too sure he's uh, going to be proven right about that. And you probably want to know what happened to gold and silver. Well, gold and silver, um, the prices that we see, they are highly speculative trades in the futures markets. Um, the majority of people on Wall Street and a lot of people out there that they trade gold. So they don't really buy physical gold. And when they trade gold, futures market or OTC, they leverage. They're not buying gold and silver to protect themselves versus a major crisis like that article was talking that we could have. They do it to make profits in the fiat currency. And yeah, so if you think the fiat dollar, the fiat pound, or the euro are really solid currencies, that there's no problem out there, yeah, forget about gold and silver. Just stay in the game. So yes, it's frustrating for people like us who have been acquiring gold and silver, some for a few years or only the last months, or like in my case, for many years. But I know how it's been. It's frustrating sometimes, but I feel much. I sleep a lot better at night knowing that I have something outside this crazy system. So that's all I would say. I wouldn't worry about, yeah, gold dropping below $2,000 or below 1,600 pounds. I think it's all going to come out in the wash. Well, I don't think, I'm sure it will. We just need patience. Um, yeah, we need patience because we know how fragile this system is. We know that eventually unless they want to see everything collapse. And in that case, I want to have gold and silver too. We know eventually, though, that they'll have to come to the rescue again. And that seems to be what the markets are clamoring for, despite the fact that recently we traded above 5,000 in the S&P. We made new highs in the NASDAQ, and it's a crazy world, financial world, and also, of course, real world. So yeah, I won't look at the markets this morning. Don't want to keep this going too long. I would say though that yeah, let's keep an eye on gold, silver, even though as I said, um, I'm not concerned. Let's look at the stock market. It did rebound a bit at the end of the day, but I think the Dow still dropped like 500 points. And we need to keep an eye as well on that 10-year yield. That's really important, not just for the markets in general, but also for commercial real estate and the economy in general. So, with that, I'm going to wish you all a very good day. Take care. Bye.